everyone, and welcome to Economic Impact. Today is April 16, 2024, and as usual, I am with Stéfane Marion, our chief economist. Stéfane, welcome again.
Good morning, Denis.
We have to come back to, performance of stock market in this start of the quarter.
Not that great.
No.
It's pretty much negative across every region, Denis. Still positive year to date, but there's some malaise in the market at this point in time to start the second quarter, Denis.
And that malaise is probably linked to inflation once again.
Yeah, the big I world, where the inflation numbers are not good, particularly in the U.S. It's been accelerating over the past 3 months. If you exclude the housing sector, you're running at roughly 8% annualized rate. The market was not happy to see this, Denis. And what that does is that, if you recall, back in November, Jerome Powell went on the record to say that I will have the ability to reduce rates aggressively in 2024. Well, with these inflation numbers, the bond market does not believe that anywhere. So it's pretty much back to square one for the Fed, with the bond market probably targeting a level of 5% again, just where we were last November.
Yeah, it's a nice comeback. But at the same time, we have gold making new high.
Yeah, it's not just the bond market that's doubting the Fed's ability to cut rates, Denis. The price of bullion now is at an all-time high, above $2,200 an ounce, US dollars, by the way. But adjusted for inflation, the blue line was still 20% away from the all-time high that was reached in the 1980s, which was above $2,600. Denis, I'm going to make a forecast. I think we will get closer to that record high in the coming quarters to reflect, the global uncertainty related to inflation, but also the geopolitical backdrop.
But talking about uncertainty, at the same time, we have the stock market going very well, but when you compare to Fed fund, there's a question that should come in the head of the investors right now.
Well, the valuation question is a good one, Denis. And if you look at currently the return you get on the earnings yield on the S&P 500 versus the Fed funds for the first time in over a generation, you get a higher return on just holding Fed funds as opposed to buying the stock market. You're just not compensated for the amount of risk that you're taking in the stock market, unless you think that the Fed is able to cut rates aggressively in a not too distant future. So again, they need to see this type of stretch valuation. You have to go back to 1998. So it's the type of stuff you don't see very often. So the Fed has to be able to cut rates quickly. If not, you have to reassess your valuation on the stock market. Hence, our reason to be a little bit more prudent at this point in time.
Either or, rates will go down or stock market will go down.
Yeah, you're absolutely right.
But you cannot keep going like it is right now. That's unsustainable.
Yeah.
And at the same time, uncertainty about policymaker is not that great too, huh?
Well, when you're trying to forecast your earnings guidance, you try to say, what's my outlook in terms of economic policy? It's not very stable right now, Denis. Or if it's stable, it's very stable on the high end of risk. And economic policy, the average of the past 5 years, is outside the norm that we've seen since 2015. So from a stock market perspective, that's not that great to cope with both monetary policy uncertainty as well as economic policy uncertainty that reflects the more complicated geopolitical backdrop. We just saw what's happened with Iran and Israel right now. I mean, this is complicated right now.
And all of that, U.S. small business index is still going down, which is not good.
Yeah, you're right. Like consumers, corporations don't like uncertainty, and small businesses in the U.S. who account for 50% of job creation, Denis, are not very confident right now. It's actually the lowest level of confidence since the great financial crisis. So that argues for a more tepid job creation environment for the U.S. in the months ahead. So, yeah.
And there's one thing going up, though. Demand in electricity.
Well, that's surprising because if you're a small business, you're coping with, monetary policy uncertainty, geopolitical uncertainty, and now energy price uncertainty, because for the first time in generation, U.S. electricity demand is on the upswing. That was not supposed to happen. No one was forecasting this, Denis. And the reason for that is we all knew that U.S. was planning to reshore manufacturing activity, but no one guessed that IA, artificial intelligence, AI, was going to be deployed so quickly, and that is so energy intensive, Denis, that now you have to increase your energy production or electricity production. And in the US, it's mostly coming from natural gas and coal for 60% of electricity generation. So what that means is for everybody that was saying, well, all these governments have these plans to decarbonize under X many years, all of a sudden with surging demand on electricity, you have to push that back. So again, the uncertainty is even at the decarbonization level. What can government do under these circumstances? What it says to me, Denis, I think those targets will have to be pushed back, unfortunately, because you can't reshore and do AI with no electricity consumption.
Yeah, and you cannot build those dams at the speed that we need to achieve those goals.
Alternative energy cannot be deployed as quickly as the demand is rising right now. So yes, Denis, it means more uncertainty on that front too.
And more to come on that front. But at the same time, this morning we had a Canadian inflation. Any surprise?
Okay, I'm here to provide some good news, right? Yeah. So yes, the good news was that the Canadian inflation was actually lower than expected. Denis, having said that, headline inflation is at 2.9%, which is well above the 3%, the 2% range by the Bank of Canada. Having said this, it's mostly driven by shelter, which is at above, close to 7% right now, as you can see on the slide. Excluding shelter, however, you're at 1.4%. So, Denis, to me, clearly those inflation numbers open the door for rate cuts in Canada before the U.S. So we're going to get them here before the U.S. for sure this year.
And that's why the Canadian dollar is at 138 right now or so.
Again, everything correlates with something else. And yes, under these circumstances, you're going to get a weaker Canadian dollar, which has been our forecast for quite some time. So we're probably looking at another 3 to 4 cents depreciation of the currency. It's been a significant depreciation over the past few weeks. Expect a little bit more because now the market have to reassess the fact that, yes, the Bank of Canada is able to cut rates before the Fed. So there's a currency impact on that.
Then to bring down that inflation due to shelter, we need to build houses, and a lot.
Yes, so finally, in Ottawa, they've come to the conclusion that the only way to bring down shelter inflation is to increase supply of shelter. They have deployed a very ambitious plan to build 4 million homes in the next 7 years. So that would be doubling the number of home starts versus what we have right now. It's very ambitious, Denis, and at the same time, it comes against a backdrop where we already have a record number share of the workforce employed in the construction sector. So we don't just need people to build homes, right? At the same time, we need more schools, more hospitals, more roads, more sewers, et cetera, et cetera. So that means that if there's one sector that's going to be busy for the foreseeable future, it's the construction industry, which is not bad news because it will limit the downside to the economy, but clearly something that might be supportive of the economy. But it's a very big challenge to meet the goals that were presented on April 12th by the federal government. Doubling home starts at this point in the cycle is a tall order, but at least we're going in the right direction.
On that note, thank you, Stéfane. Thank you, everyone, for being with us. We'll see you next month.